With a technical look at the markets, Katie Stockton, founder and managing partner at Fairlead Strategies, a CNBC contributor. Let's cut to the chase, Katie. So this is a historically, seasonally strong period. It just adds to a rally that we're seeing that is still in the midst of a longer-term bear, in your view, but maybe it looks like it goes a little further before we head back down.
Yeah, I mean, the seasonal influences definitely don't hurt, but we now have a relief rally that's been in place for several weeks, really since the beginning of October. That's when we saw short-term momentum shift to the upside. Short-term momentum still is to the upside, and we want to be respectful of that. And yet we are starting to see some signs of exhaustion, and that's what we're focused on here near term. We want to, ride the relief rally until it really fully matures. The S&P 500 is fast approaching its 200-day moving average. Even with today's weakness, there's no impact on our short-term gauges. And yet we think that any breakout above that 200-day moving average would be pretty short-lived. And it's in part related to the action today in the volatility index, or the VIX. We have a little bit of a gap up there, and that gap up follows some signs of short-term downside exhaustion for the VIX as of last week. So that has us definitely paying attention, looking for perhaps an increase in volatility. And if that does impact our short-term gauges, then we'd react to it.
Not to be long-minded, but if the S&P were to go further than you thought in terms of up, if it got through 4,200, what do you think the percentage chances are that it could keep going to 4,400 or 4,500? Is it zero? And how would you explain that if it happened?
Well, it's hard to assign a percentage, but I think it's a pretty low probability that we could get to 4,200. I think that's reasonable to expect, perhaps. There is resistance around 4,150. Yeah. But that's it. And I think it's a somewhat of a low probability. And I think an extension beyond that is an even lower probability. And I say that because the long-term momentum gauges still do point lower. We really don't have any basing phase in place yet. And most bear market cycles, or I guess all, really, at least in our lifetime, have resulted in some kind of bottoming process rather than like a V bottom, which is what this would have been. So to us, it's not a corrective phase. Those corrections can last in a V bottom fashion, but not a bear market cycle like this. So we expect some kind of series of retests of support. So even if we see a run up to 4,200 plus, we would expect a very significant retracement. So it's not something that we'd feel the need to chase.
Okay, we got that. How about let's look at some other markets like oil. Is oil in a breakdown phase now?
It's not really a breakdown. I mean, we know there's been a very significant loss of long-term upside momentum behind crude oil, and we're feeling that very much here near term. We suspect there's a long-term trading range intact here with support between about 70 and 75. So it's into that support zone longer term. But momentum, of course, short term is to the downside there. And now the energy stocks are starting to feel that. But would keep in mind that they had a really strong run up. And the same I could say also about Chinese equities. We saw a really big run up there too. So we would contextualize any kind of pullbacks in these areas that are sensitive to crude oil as something that is a retracement of what we've already seen.